While I love Impact Partnership, I
Uh-oh.
will say that
Uh-oh.
marketing organizations have somewhat contributed to this phenomenon.
Welcome into Impactful Conversations, stories and lessons for financial advisors. I'm your host, Dave Edgecombe. Joining me, we got Cheryl Moore. Cheryl Moore is the CEO of Wink. She's the most connected person in life insurance and annuities and a self-anointed product geek. Cheryl, thank you so much for joining us. Sorry I had to slip that in there, but I do love a good title, and I love it when someone's willing to call themselves a geek. So thank you so much for joining us.
Yeah, thanks for having me.
We won't be talking products specifically from a obvious compliance standpoint, but what I do want to pick your brain about is just some of the best annuity products and what their features are, but overall kind of just the industry itself and what you're seeing, and maybe I'll have you look into your crystal ball and maybe we'll kind of assess, the things that are of concern to you right now in the industry, in the life insurance and annuities standpoint. But I'll start with sort of that topical day to day, the average person hears about, they know the name Jerome Powell, they know the Fed chair's name, and they hear it and they see the back and forth between President Trump. So from your vantage point and what you do every day, how locked in are you to the day to day kind of ebbs and flows of what's going to happen with interest rates?
So I look at the 10-year Treasury on a pretty regular basis just because it's the primary benchmark for pricing fixed and indexed annuities. So I know that it's going to be helpful to annuity sales when the 10-year Treasury is doing well. I also like to check out and see how like the S&P 500 is doing, just because variable annuities typically go down when the market's down. Index annuities are relatively insulated, but market's performance can have a short-term effect on sales of those products. And really, when we see volatility in the markets, that lends well to sales of fixed or indexed annuities. So I keep my eyes on that a little bit, but if you had asked me, a week ago, what do I think about Jerome Powell, I would have said, he's very tactful. And I enjoyed watching President Trump back up on his comments about Powell and act like they were friends. So,
What's the correlation between, you mentioned volatility. We talk with advisors all the time about volatility, and that volatility can be a good thing if you're positioned properly. So what's the correlation between that volatility and why, certain annuities can be so valuable in that standpoint?
well, I think of indexed annuities first when it comes to that. And volatility actually can positively or negatively impact pricing on indexed annuities. But when you're talking about buyer behavior, anytime there's volatility going on in the markets, that lends well to increases in the indexed annuity sales. So, I've been watching it lately. The market is at like all-time highs, and I would say it's a great time to buy an indexed annuity or index life, just because if there's a market correction, you're protected by that downside of 0%. But when the market recovers, you'll have opportunities to cap out. So, yeah, that's what I'm seeing from my standpoint.
Pause for concern when you see the markets doing really, really well? Is it sort of just the skeptic in me that says, well, the other shoe, when's the other shoe going to drop, kind of thing? Are
I'm
you thinking
I'm
that
that
same way?
same way, Dave. I really wonder when it's going to come back down and how severely it's going to come back down.
I was digging around Limra's and Loma's websites before our call, and I came across a stat that was something to the effect of, in 2023, half of retirees had pensions. 10 years ago, it was nearly 2/3. The landscape for retirement has really changed in the last 10 years. What about that change has lended itself really well and lends itself really well to the annuities landscape?
Well, annuities are actually a pension that you create for yourself. So I would say the disappearance of traditional pensions has lent very well to advisors being able to discuss annuities, especially once they understand what an annuity is. And although I'm sorry to see pensions go by the wayside because they had such valuable benefits, it's a great opportunity or shoe in to talk about annuities because they're the only instrument that can provide an income that you cannot outlive. So even if you live to be 150 years old, you will still receive payments from the insurance company for that annuity. And I think that's a really great story because consumers right now, their number one fear is running out of money in retirement. It's not death, it's not public speaking, running out of money in retirement. And insurance companies are strategically positioned to address that concern.
New goal, live to 150 years old. I think I'll start working towards that. Well, when an advisor doesn't sell annuities and is I don't want to do it, do you have two sort of selling points or two, like, hey, let me hit you in the head real quick with this to show you why you're wrong?
Well, the first thing I always think of is that some financial planners specifically don't use annuities within their practice because they're commissionable products most of the time. And they're really comparing the idea of the annuity to the things that they normally sell their clients, like mutual funds and stocks. And I really have to get on their level and say, look, this is not about achieving greater alpha. Annuities are about protecting income and mitigating risk. So that's my number one argument to them. And then number two is, hey, you don't have to get paid a commission if you offer an annuity to your client. There are dozens of fee-based annuities that are available for sale today that may fit better within their business than a commissionable annuity would.
Do you have a preference one way or the other about which one is better?
Well, the answer is
that's a
that
tough
depends.
question. Yeah.
If the client holds the annuity for the surrender charge duration, typically the commission ends up being a better deal for the client and cost them less, just because for those financial planners that charge assets under management, that will eat into the annuity's value every year as they're taking the money out to pay themselves. So the commissionable product ends up being more favorable for the client after about year 4 in the study that I conducted of fee-based versus commissionable annuities.
What else did you learn in that study?
I learned that annuities are really not embraced at all within the financial planning community. There's so few advisors who use them. And that was interesting for me just because I've been approached by financial planners a lot in my 20-something years. And generally they pitch their services as a way to handle all of your needs or provide solutions regardless of what your concern is. And I thought the fact that life insurance and annuities not typically being an option with those financial planners was a huge gaping hole in their business, especially when you consider how the annuity guarantees the lifetime income. There's not another instrument that will do that. And when you consider the living benefits that are available in life insurance products, that was really surprising to me to hear they don't use life insurance especially. But there is a faction of financial planners that will suggest term life insurance when they perceive there is a need for life insurance. But to that, my argument is, well, only 2% of term life insurance policies experience a claim. And your buy term and invest the difference theory works great in theory, but not in practice.
Well, before our call, I went around the halls of Impact talking to various people here, trying to figure out what they would want to know from you. And I stopped by our life team, and they wanted to know candidly, what does she have to say? What's the biggest missed opportunity from a life insurance standpoint that advisors are missing out on?
Well, I really think the living benefits story is huge, just because most people, when they think of life insurance, they think of something that pays a tax-free benefit to your heirs upon your death. And not a lot of people talk about how you can use the cash value within your life insurance policy if you become chronically or critically ill. And those are things that we need to do better at educating people on. So, the fact that life insurance is not just for when you die is a huge missed opportunity for us.
You mentioned education. I'm a big fan of analogies. Do you have an analogy that you use in that scenario to try and explain, the value of what a life insurance policy can be for you aside from protecting you in death?
Let me think on that, Dave. I'll get back with you.
We'll circle back on that one. My life team, they're big on long-term care and establishing the plan before the need arises. What do you see on the long-term care front that an advisor can do or should be doing with their clients?
Well, those products are often called hybrid or combo products, where you're combining the benefits of a long-term care policy with life insurance or even annuities. And I think that the appeal is fantastic. There's still a lot of us who are educators that need to master that message, just because this is a product where, yeah, you get your life insurance benefits going to your beneficiaries if you pass, but what if you become confined to a nursing home? I'm personally going through that situation with my father now. And the one thing I keep saying to myself is, gosh, if only he had bought a combo life insurance policy that we could use for this care. Because the nice thing about those combo products is that you can use the money while you're living to cover long-term care expenses out of a life insurance policy. And if you don't use it, it's not like traditional long-term care. You don't lose it. You still have the life insurance benefits from it. So I would say we need to do a lot better job about educating ourselves on those products and their features and benefits, and go out and tell the story.
What's the average person say when they hear some of the benefits of how the other ways that life insurance can work for them? Because I'm like, I thought, life insurance has one purpose and one use. But I've since learned that that is very inaccurate. Is that generally the consensus from the average person, is they just don't understand what kind of a vessel life insurance can be?
Well, absolutely. And, when you think about the fact that most consumers, when presented with the suggestion that they buy life insurance, they'd say, no, that's okay. I already have it through my job. That's actually a big, huge red flag, because do you know if it's portable? Can you take it with you if you're no longer employed by your company? And how much life insurance do you have? Is it enough to cover your income for your family should you have an untimely death? I mean, those are big, huge questions that you have whenever somebody gives you an objection to like that to life insurance. But I would say 99% of the time when I talk with consumers about life insurance and its benefits, they have no idea that you can use it for reasons other than paying a benefit on their death.
Any other red flags that jump out? Because you mentioned red flags, and I think those are huge opportunities and missed opportunities for an advisor to jump all over. A prospect or a client says, "Oh no, I have my employer's life insurance. I'm good there. What else you got?" Is there another red flag that's like, whoa, if they say that, you need to be saying this in response?
Two things. Number one, life insurance is too expensive. And number two, oh, I'm not anywhere close to dying. I don't need to worry about that yet.
Okay, so what does an advisor do when he hears that? Besides roll his eyes and say, "Oh man, where do we start? Where do we begin?" What's the first course of action?
Well, when it comes to, I don't need life insurance because I'm nowhere close to dying. Did you know that life insurance is actually less expensive when you're younger? And the longer you wait, the more it will cost you. That's a great retort to that objection. And then, if people don't understand the value of life insurance outside of the death benefits, then I really think that speaks to us as an industry and how poor of a job that we're doing. Certainly, we aren't telling that story as well because we're using independent agent distribution. And that means that the insurance company is subcontracting out a lot of things that they traditionally would have handled to a marketing firm or a brokerage general agency. And it's their job to educate agents, but it's not their job to educate consumers. And so what are we doing to overcome that disconnect? I think that's really important. And gosh, it really makes me appreciate the very few insurance companies that run television ads or have advertisements in print magazines. I mean, we still need to get consumers comfortable with the idea of dealing with an insurance company. And we're really failing at that, Dave.
Are we failing at that with annuities as well?
Oh, Absolutely, 110%. We do a much worse job talking about annuities than we do life insurance.
Well, why is
There
that?
are insurance companies that distribute through a captive or career agency field force, very old insurance companies, recognized names, and they at least advertise about the value of life insurance occasionally. We don't see that for annuities at all. And in fact, I would say that I see more ads for the guy who says, I hate annuities and you should too,
Ah,
than I do for anything that would talk about the benefits of annuities.
one thing that jumped out to me when we had our pre-call last week to go over what we were going to talk about was how annuities have kind of changed and how they've become really, really complex. And a couple came across your desk that took you a minute to kind of get through and better understand.
Mhm.
Are you concerned about the complexity of annuities from the industry standpoint?
I absolutely am. It's a huge concern right now, and it's really something that started back in 2012. As a reference point, I would say any time that fixed interest rates are not competitive, I start to see innovation in the annuity space. And it has just escalated since 2012 and become worse with each passing year. Those two products that I mentioned to you that I was reviewing last week, they not only took me hours of reviewing and rereading, but then I had to craft language in layman's terms to help people understand how these features really worked. And I'm a product expert. Dave, I've been analyzing products for 26 years in the life insurance industry. If I can't get it, how is the agent going to get it? Or much less, how is the consumer going to understand? It's almost like insurance companies are innovating for the sake of innovating.
That brings me to my next point, because when I talked with the head of our advanced resources team here, he mentioned that same sort of concept, and it got us kind of going about the difference between evolution and change. You know, evolution takes time, change can happen like that. And you mentioned innovation and things changing just because they want things to change. Do you feel that, yes, the industry, I'm sure, has changed over the course of, annuities existence, but are you finding now that the change is happening a little too fast and it's not really happening for any real reason?
Yes, absolutely. And while I love Impact Partnership, I
Uh-oh.
will say that
Uh-oh.
marketing organizations have somewhat contributed to this phenomenon just because one marketing group says, hey, XYZ insurance company, I really like doing business with you, but I need a product that's different from my competitors across the street so that I can get the attention of independent insurance agents who can do business with just about every company. And so we see insurance companies wanting to help with that challenge, but there are no new ideas in the annuity business, is what I like to say. Now, granted, we do once in a while have really astounding innovations, but innovating for the sake of innovating and giving someone something unique to recruit to sometimes is a double-edged sword, because if the agent can't understand it, they're not going to sell it.
What's been one of those big innovations through the years that you look back on and you say, boy, that was a real turning point for the industry. That was a good thing.
Um, well, I don't know that I've seen an innovation where I really felt that way over the past decade or so.
Mm-hmm.
Most of those innovations have been things to set an annuity apart from its peers, but maybe does not add tremendous value to the
Okay.
client.
Okay.
So there's more of that. And, some of it is smoke and mirrors too. So advisors really need to do their due diligence when deciding which products to offer to their clients.
So the head of our advanced resources team here was telling me about, not necessarily a horror story, but their experience with a provider that was expanding their menu, so to speak, and was offering more and more different varieties of annuities. And it hasn't been going very well this year. And they've been very, very frustrated by what that provider has been offering up to them. And I likened it to a restaurant that has a million things on the menu versus you go to a restaurant and they do five things, and they do five things really, really, really well. should the average advisor be more drawn, especially if they're new to annuities? Should they be looking for that carrier that does offer sort of a limited amount versus that one that's going to be a Cheesecake Factory type of menu that you have to comb through and find the value in?
You and I were thinking of the exact same restaurant, Dave. I was just like, I go in there and I don't even know where to start with my order because they have like a 45-page long menu. I definitely think that if you're a new advisor, sticking to the phenomenon of keep it simple, silly. That's how I like to present it.
Good little edit there. Okay,
I don't like
kids
to
watching.
offend people, so if you stick to products that are relatively simple, that's a great way to start, especially if you're talking about a relatively more complex product like an indexed annuity or what some people would refer to as a RILA. Keeping it simple really helps until you have a firm grasp on the products. But there are products out there, in my opinion, that really don't have a viable market just because of their complexity. And I often don't worry about those products, to be honest with you, Dave, because if the sales don't come through on those products, they eventually get pulled for new sales. So sometimes I just roll my eyes when I see some of those features on the products that complicate them.
Is that how the industry works? It's sort of a dog-eat-dog world? Like if it doesn't pan out, it's off the menu?
Yes, absolutely.
Does that help regulate it then, I guess?
The self-regulation, yeah, I would say that definitely helps. But the other thing to keep in consideration is the insurance company often has the mentality of, well, we spent X amount of dollars in order to get this product to market. Let's leave it out there for a while until we can recoup our costs. And that only goes so far if, the sales are dwindling on a regular basis.
What do you think, if I ask you to look in your crystal ball, looking down the road, what do you see from the annuity space going forward the next couple of years?
I believe that annuity sales are going to increase exponentially. And I credit most of that with the passing of the Secure Act several years ago. That was legislation that makes it okay for annuities to be within 401k plans. And because of that, we have seen not just a slowing of the negative and inaccurate media when it comes to annuities, but we're actually seeing positive press about annuities. And that's huge because I do fact checking on all the journalists who write about life insurance and annuities and cooperate with them to make sure that what they're reporting is accurate. And at one point, about 20 years ago, I was correcting or reaching out to journalists 8 times a day. So 8 different negative or inaccurate articles about annuities. And today, I typically don't see one a day. So the Secure Act has done a lot to help advance the narrative about annuities. And I just think that the longer people have to sit and think about the implications of having annuities within 401ks, more people are going to say, well, what is this annuity thing? Or trusted financial advisor, can you tell me more about annuities? I heard about those. So what is it? They say a rising tide lifts all boats.
Yep.
I believe that for that reason, we are going to see increases in sales of individual retail annuities, just like your advisors sell.
What's your elevator pitch for an annuity to the average person? I've mentioned annuity to my mom who's retired, and she said, no, I heard annuities are bad. And I didn't have an elevator pitch. I didn't know what to say. So what do you have in that scenario?
So I asked if I could tell you about a product that would guarantee you a minimum amount of interest and promise that you'd get a paycheck every month for the rest of your life. Is that something you'd like to hear more about? But most people, when they hear the word annuity, respond exactly like your mom did.
Okay, so you got that going for you, Mom. You're in good company. You got everyone else with you. Are advisors scared of the word guarantee and what that connotation that kind of comes along with it, and people just immediately put their guards up because it sounds too good to be true? Mm-hmm. Do advisors need to do a better job of sort of marketing around that guarantee? Like a guarantee is a guarantee, but do they need to find a more creative way to sort of pitch that?
Well, I think actually we need to think about guarantees when it comes to annuities because the one sentence that is on the front of every annuity contract is the guarantees in this contract are only so good as the claims paying ability of the insurance company. And a lot of advisors don't realize that because they haven't had to go through the process of an insurance company not being able to make good on their guarantees. But we did have a couple of insurance companies about 5.5 years ago that became insolvent.
Okay. Yep.
We have another company right now that is going through the insolvency process. And so I would say advisors need to do really intense due diligence in order to determine which company are they going to work with, which products are they going to be able to sell. But when it comes to those guarantees in the contract and communicating them with clients, I think advisors would do best to remember that these are complex products, and likely what the client is going to do is compare the product that they're being pitched to an instrument like a certificate of deposit. So if you can change your messaging to kind of match up with what they're familiar with, that really helps.
How does the pitch change when it's a 50-year-old client versus a 70-year-old client?
People don't normally suggest annuities to 50-year-olds, although I will tell you I bought my first annuity when I was 29 years old. Just because most people who are 50 are still working and probably contributing to a 401k. And really, annuities change so much. So I will tell you that the annuity that I bought when I was 29, I don't own anymore because it came out of surrender charges, and I did a 1035 exchange into a different annuity with more attractive features than what my initial contract had had. So when you decide to pitch an annuity to someone who's only 50, that means you're going to have an ongoing relationship with this person, because at some point they'll probably want to have an upgrade or a switch of the product that they purchase, just because things that are more attractive have come up since that original contract was sold.
What kind of red flags are you seeing, or should advisors be aware of in an annuity?
Well, the complexity is number one, Dave. I mean, if they're struggling to explain something, they have to know that they're going to lose confidence when speaking with the prospect. So that's a huge red flag. But the other thing I like to train agents about is that there's only 100 pennies in a dollar when it comes to annuity pricing. And there's 3 legs on the stool of product attractiveness. So the insurance company needs to make their profit or their spread. And I will assure you, they are always going to make that spread, or the product won't be available for sale long. Number 2, the agent has to be paid a fair commission for the product. And number 3, the client needs to get a fair return or cap in the event of an indexed annuity. And so if any one of those 3 legs is longer than the other 2, you need to be aware of that and say, where is this coming from? Because if the insurance company is always making their spread, and let's say the agent's commission is higher than what you're seeing on other similar products, I can assure you that means the client's leg of the stool is a little bit shorter. And so that's something we could use a little bit more due diligence on, is evaluating, why is this product so much better than similar products in the market?
Cheryl, I know we've covered a lot. I'm sure we've only scraped the surface, though. Is there anything that I forgot to ask you? Is there anything else that you really want to take this opportunity to share to the people, or share to an advisor about annuities or about life insurance and what they're missing?
Well, I have a personal experience with annuities. I bought one because my 401k turned into a 201k, and I do not feel comfortable with the thought of losing money. And so when I first learned about the products, and everyone was talking about tax deferral, and I just didn't get it. But then someone finally said, this is an instrument that can give you a paycheck for the rest of your life. That was when the light bulb went off for me. So if we can do a better job educating consumers, prospects about the features of annuities, then we will get more people that are interested in purchasing them.
What are 2 features of an annuity that you love, without getting into specific products?
Well, recently there was a company who came out with a best entry feature, where if the market goes down dramatically within the first, let's say, 6 months, Then that low point is the starting point for our index measurement on an indexed annuity. So I thought that was really great. But if I had to pick one idea, I would just say choose simplicity. Using the S&P 500 with an annual point-to-point measurement and a cap is not the worst thing in the world. It's something that the consumer is more than likely going to understand relative to a product with 50 different choices for allocating your indexed interest.
An advisor probably needs to understand an annuity. Does their client necessarily need to understand the annuity, or is that the trust that gets kind of built up there?
Well, I like to tell people that I don't need to know how an internal combustion engine works in order to appreciate that I can get from point A to point B in my car. Likewise, I would say a discussion of how these features are being offered to you is not really important as long as you understand the benefits and how this works. So I definitely think, you can get in the weeds on these products, but it's easiest to convey to the client the benefits and how it will help them address their needs.
Couldn't have said it better myself. We got combustion engines. We got all kinds of talking points here. Cheryl, thank you so much for taking the time, educating, and sharing a little bit of your insight into the industry and what you see and looking into your crystal ball. I really appreciate it.
Thanks so much, Dave.
If you're looking for more resources to grow your practice, our Impact YouTube channel is a great place to start. We've got house rules, selling with stories, testimonials from a lot of the advisors that we work with. They're all great resources and all great places to start. And of course, like and subscribe. We'll see you next time.